This is not just a credit crisis. It signals the onset of an economic downturn poised to significantly alter our lives. According to warnings from Goldman Sachs and other major Wall Street institutions, credit crunch is on the verge of causing a substantial increase in bankruptcies across the United States. Millions of Americans are facing the risk of losing their jobs due to the impact of Federal Reserve policies. Currently, the largest American banks are deeply concerned about rising credit defaults and default cases. Consequently, they are reducing debts provided to businesses and consumers at considerably high interest rates. There is a high probability that both companies and individuals will struggle to delay credit payments, leading to significant increase in potential financial losses for banks. These major financial institutions are recognizing trends that signal trouble for the U.S. economy. Customers are withdrawing larger amounts from their accounts every month and saving less, indicating that many people may turn to borrowing more as their savings dwindle. Similarly, American businesses that borrow during a period of low inflation and interest rates are experiencing cash flow problems and difficulty repaying debts due to the current high-interest environment. As consumers reduce spending, many companies witness a decrease in sales while operational costs, including labor and leasing, remain at peak levels. The Federal Reserve's interest rate hikes since the first half of 2022 have significantly increased borrowing costs, thereby increasing banks' exposure to bad loans. As a result, these banks are limiting access to credit limits in response to the growing potential threat of bank failures. The outlook for U.S. banks hasn't looked this challenging since the great financial crisis of 2008. Tightening credit standards is a method these firms are adopting to protect their funds and prepare for the worst-case scenarios. These savings will serve as a buffer when a real crisis emerges. They allocate more funds each quarter in anticipation of an impending economic or financial market collapse, indicating something significant on the horizon. The reasons are simple. Particularly in a period where various indicators predict increased turmoil in the coming months, the industry is trying to maintain stability following the sharp downturn in April. These banks aim to halt financial hemorrhaging by cutting credit limits before it worsens. However, this action also cuts off a critical lifeline for struggling companies, potentially leading to an unprecedented increase in business bankruptcies. Since the beginning of the pandemic, Main Street has continued to face challenging conditions that haven't improved much. As interest rates rise, drawing more liquidity from the system, more small businesses, especially those already with long-term support, are likely to encounter profitability and cash flow issues. This situation could potentially endanger hundreds of thousands of businesses and add to the bankruptcies already occurring this year. Data from S&P Global shows a sharp increase in corporate bankruptcies in 2023. Economist Peterson attributes this problem to a simple factor. Banks are not lending. Credit conditions for small businesses remain at stagnant levels consistent with the downturn, and the number of medium and small businesses filing for bankruptcy in the last 9 months has surpassed previous high levels. Tight credit conditions often precede or accompany declining profits for small businesses, leading to a decrease in employment growth. Instead of addressing the growing problem of business closures, the U.S. government is further restricting businesses' access to credit by imposing new capital rules for large and regional banks. The initiative known as Basel III Endgame, B3E, forces banks to increase reserves by 16% when lending to companies with less than exceptional or perfect credit ratings. This move, aimed at making lending more restrictive, exacerbates cash problems for struggling small businesses. Ultimately, as more account holders withdraw their funds from the system, these regulatory changes further exacerbate the challenges faced by small and medium-sized enterprises. The measures outlined in Basel III unintentionally disrupt small businesses, worsening their financial difficulties. Meanwhile, Bank of America is concerned about the impact of these policies on American consumers. In March, analysts from Bank of America warned that the Fed's actions to reduce inflation could push consumers to their limits. Bank of America CEO Brian Moynihan highlighted a significant shift in consumer behavior in an interview with CNBC. Consumers' spending amount showed a significant decrease to 4.5% in the third quarter of 2023, dropping from a 10% increase from 2021 to 2022. This decline indicates that consumers are either hesitant to spend or are reducing their savings to maintain spending levels. Moynihan emphasized that the interest environment and associated factors are slowing down consumer activities. JP Morgan executives expressing these concerns supported Citigroup CEO Jane Fraser's observation of signs of pressure on consumer spending. A new survey by the Associated Press confirmed these concerns, revealing that many Americans are outpacing their incomes with household expenses, prompting them to save less for the future. The survey found that about two-thirds of Americans reported an increase in household expenses last year, while only one-fourth experienced an increase in income during the same period. Most survey participants indicated that their household debts had increased, with a significant portion carrying credit card, auto loan, or medical debts. However, only a small portion reported an increase in household savings. Individual stories in the survey reflected this financial strain. Steve Shapiro, a 61-year-old participant, shared that despite a stagnation in his income, grocery expenses doubled. He expressed financial concerns and the difficulty in achieving retirement goals. Tracy Gonzalez, a 36-year-old construction worker, found herself facing a significant medical debt due to a surprise dental infection and ended up avoiding medical treatment due to expenses. Moreover, the survey showed that more than 3 out of 10 Americans had to forego major purchases or medical procedures last year due to rising interest rates. This situation raises concerns about how millions of Americans facing similar issues will cope if the credit crisis continues to affect businesses and jobs, ultimately impacting their ability to meet basic needs. The situation appears grim, with the potential for far-reaching consequences across society. There is widespread concern about how individuals will manage being unemployed and having limited access to credit. This crisis has the potential to impact various aspects of our society, and the sufferings experienced so far may only be the tip of the iceberg. The consequences are dire and the solutions are crucial. Your thoughts on this matter are greatly appreciated. Thank you for watching WealthStream 101. Please don't forget to subscribe and leave a like under this video, and let us know your thoughts in the comments.